Hi entrepreneurs, and welcome to another Starting a Business e-learning video class. This is Tony Brancatella, and we are finally entering into the last module of the business plan course, and that is the financial plan. Financial plan, we're going to take a look at different aspects of financial plan, but because of time restraints, we were certainly not going to go into details about every single little thing. But we will touch base on quite a few things as we go along, and I will give you a helping hand to do your finances, to finalize your finances for your business plan. So certain aspects of a financial plan, we're going to look at costs to acquire a customer, one customer. Also at the same time, look at lifetime value of one customer. Quick look at cash flow and cash budget. IS or income statement, BS or balance sheet. And we're going to take a look also at ratio analysis, which is my favorite part of finances. So financial plan, why do we do it? Why is that important? Well, it includes all these various statements that we looked at, but it also helps to determine how much financing your business needs. But also more important, it also determines whether investing in that business or in a business is a good thing or is it a risky thing. So when we look at ratios or calculating financial ratios, we're going to look at ratios such as profit margin, which is a very important aspect of your finances, return on investment, ROI, and also your break-even point. Like I mentioned, we're not going to go into full details about these, but we will take a look at them in this financial plan. So what do ratios do? Ratios help a lot in finances to look at certain information a little bit closer. Such thing as cash flow, liquidity, how much money you make, profitability, how much money you owe, which is the debt, and also the valuation of your investment. Now all these factors or all these ratios really are stats that look at numbers, money in, money out, what's worth and what's not worth it, what's risky or what's not risky. But one thing that sometimes is overlooked in finances is the actual customer aspect, or the importance of the customer aspect in the actual success of a company or not. So we're going to take a closer look at that aspect too. So I'll give you an example. So let's take a look at a scenario, I should say. You're going to the gym. You go to Nautilus, and Nautilus charges you, let's say, $20 a month. So annually, $20 a month, you're going to make they're going to make $240 off you every year. So customer value would be $240. Or if you look at it a little bit further down the road, if you stayed there for 3 years, your customer value is $720. Now, a lot of these memberships, for new customers, they always give you these discounts. So you get a nice discount right off the bat with the Nautilus, let's say. They give you $100 off. So $100 off, and, is this still profitable for them? A lot of companies, a lot of people ask themselves, will they make still money with this? Certainly, as long as, in many cases, they're spending less than, let's say, $240 of the annual fee or the annual membership, it would still sound to be profitable. So this is one way of looking at to see if it's profitable. There's not as many ways, and like I mentioned, more and more companies look at you not just for your value in 1 month or your value in 1 year or 2 or 3, but they certainly look at keeping you, as we call, a lifetime. Now here's a lot of information I'm going to show you, but this is one way calculating the lifetime value of a customer or average value of customers in general. So this is a case study done for Starbucks, and we're looking at different variables and different customers. So you got customer 1, customer 2, 3, 4, and 5. So in this case, average across 5 customers is $5.90 that they would purchase every time they go to Starbucks. So number of visits per week, so it would vary again. So this customer 4 times, 3, 5, 6, and 3. So average here per week visit is 4.2. So again, we're going to look at the overall averages here. Closer look, customer 1, 14, customer 2, 25, 25, 39, and 18. So average across 5 customers, $24.30. Many equations can be used to calculate the value of a customer, a returning customer, on a lifetime basis. So in this equation, the lifetime value of one customer could be $25,000. Here's another one that would calculate it differently, where the value is only $5,400 per se. Another one here calculates also the traditional lifetime equation, and the lifetime equation would be, let's say, $11,500. Again, these are all per customer. Now they take all these customers together and you come up with an average lifetime value of a customer that goes to Starbucks. As you can see, it's important for companies to retain customers for lifetimes. This is what they're looking at today more and more, is how much a customer could spend in a lifetime if they stayed with the same company. But let's look at another aspect of financial plan and also customers, is the cost to acquire a customer or a cost to acquire a new customer. So this is a CAC. So what is a CAC? CAC is, like I mentioned, the cost to acquire a new customer, and the cost in this is the research and the marketing costs. So this is very important in companies. It plays a very, very important role to find out what the value of that customer is. So let's take a look at certain examples that I can show you about CAC and how you calculate it. And one way we could do that is just to show you some companies, let's say, like an online company, like a business like eBay. So let's say eBay in 1 month spends $100,000 on advertising. So with that $100,000, they go out and get 10,000 new orders. So 10,000 new orders, $100,000, and the CAC comes out to $10 to acquire a new customer. So in many ways, what happens if the customer makes more than one purchase over their lifetime? What if they completely stop shopping at the brick and mortar grocery stores and they buy only from this company? This is the purposes of customer lifetime value and customer acquisition cost to your company. So that's a very simple formula to look at cost to acquire a customer, and here it is. So the CAC is the sum of all sales and marketing expenses. This could include research and also the number of new customers added, and you divide the two, it will give you the CAC as we saw in the eBay example. Here's another example. So $50,000 marketing costs, 100 customers acquired with that money, and this is $500 to acquire each customer. Do you think that's high as a cost? Do you want to lower, or do you want to increase this cost to acquire? You certainly want to lower. You want to keep increasing customers without losing existing customers. So what do you do? How do you acquire? How do you keep customers? There is always a conflict on trying to acquire new customers, spending money to do it, and retaining customers, spending money in after sales or customer service to keep your customers. So new customers versus existing customers. So a couple of questions you could ask yourself about acquiring or retaining customers is, where does your money go? Your advertising money, when you go after your marketing money, your promotions, where does this money go? Also, the other question you should ask yourself, which one is best for your business? To acquire new customers or to retain new customers? As we look at this now, put this in perspective of your business, and all of your business should have similar answers. Now let's look at a chart that shows money and time spent to acquire or to retain customers. So the first aspect we will look at is research. Research being product development or survey. And here you can see very clearly that research is used mostly to acquire customers. Same thing will be said about advertising, where it's 85%. And here, very surprisingly now, is a sales rep, which is down to 60%, where this used to be a lot higher. But today, sales reps are used also to retain customers. Where it gets very interesting for all business plans and future is word of mouth and content marketing. Here, these two aspects where the costs are very relatively low to use, the actual returns are very high when it comes to acquisition and also to retention. Where it also gets very interesting is new products, and new products is a little bit mixed bag, but most of the time it is used to retain customers versus acquiring. Where it gets very interesting is service, quality, and continuous support, or after-sales service. And here you can see that this is mostly used for retaining customers, and the importance of retaining customers, as we saw when it comes to lifetime value, this is where it plays a very, very big part. So big part here to acquire. The surprising, really important part of your business is word of mouth and content marketing, where the costs, I said, are low, but the chances of acquiring and retaining are pretty level. So now we get to the exercise part of this CAC, and that would be to determine your CAC for your business as it is today, and also budgeting it for next year. So this Excel spreadsheet will be attached, and you will have each a copy, and it's a very simple Excel spreadsheet. All you've got to do is fill in these numbers here and these numbers here. So what you're going to see in this example, let's say this is my first full year of business and my marketing costs were 5, 20, 30, and 20. And my new customers per quarter, 50 and 250 for the last 3. So as you can see, my average CAC for the year was $95. So what I want you to do is to fill in this to come up with your actual business that you had your first year. What is your CAC, or what is your marketing costs? And next also is to budget what's going to happen next year. So next year here I budgeted 10, 20, 30, and 20 for the year, and these are the customers I'm going to get in that year. So if I leave this like this and I budgeted this high, my CAC will be higher and budgeted for 2017 than it was for 2016. Is this a good thing, do you think? Or should this be the opposite? So what I'd like you to do also is, once you filled all this in, I want you to explain how you estimated your budget. How did you come to that budget, and how did you come to these customers? And also the important question, explain how you can lower your CAC for 2017 and still retain customers. So 2 simple questions that I want you to answer. Now I don't want you to use this. This is really just an example. What it's going to be, you're going to see, is something like this. So once you fill in these zeros, all these numbers will fill in, and you will get your 2016 average and your 2017 average budget also. Once you have that information, I want you to explain how you estimated your budget, as I mentioned earlier, and also explain how you can lower your CAC for 2017 and still retain your customers. Good. So that's the exercise. So if you have any questions, you can ask me them in either classroom, and I'm quite sure you will, and I'll try to explain them to you. So great. So I'll see you in class. Ciao.